UK inflation came in lower than expected, I believe. Let's pull that up. Yeah, 1.7%. And remember, when we discuss these topics about inflation, central banks usually target 2%. The Bank of England, the ECB, the Federal Reserve, their target inflation rate is the 2% mark. Well, previously we were at 2.2% for the UK. Forecast was to come down to 1.9. And now, what did we get? 1.7% year over year inflation. Prices are rising much slower in the UK than they were a couple years ago, as they are for most places. Most places are not seeing, people sometimes get the confused concept of prices. People say, oh, well, there's still inflation going on in the US. There is, but it's actually very normal levels of inflation right now, pretty close to normal levels of inflation. What you're shocked by is the recent increases in prices from when inflation was much more out of control. If we actually take a look, remember, inflation is a interesting thing. It can be sometimes a confusing topic for, for layman terms and for new investors, new traders. But inflation is a year over year report. So it's saying year over year, we saw prices go up a ton. We saw prices go up a ton. We saw prices go up a lot less. And now prices on a year over year basis have gone up still, but they've gone up a lot less, right? We're talking about US inflation for a moment. 2.4% inflation year over year is much better rates of inflation than 7.7 and when we were at the 9 ratio for US. Let's take a look at UK. Do we have that data? We do. Look at this. Inflation, we don't see it anywhere for the UK. Inflation, now, again, I'm not trying to trigger you because people will say, well, Nick, prices are massively higher. What are you talking about? Yes, prices are higher. I'm not saying that they aren't. What I am saying is that the rate at which they are increasing currently is much slower than in recent years where we got those giant price increases. No one here is going to try and dispute whether or not prices went up a lot. Everybody is aware that the grocery bill, that the rent, everything went up. It's been a frustrating couple years for the consumer. In fact, I was listening to somebody talk about how this rally here recently for stocks is one of the most hated rallies that we may have ever seen for the stock market. And part of the reason for that is because here comes, these, massive corporate gains. Meanwhile, the average, person out on the street is not feeling great, right? The costs have gone up for everything. Rent has gone up. Meanwhile, some of the biggest businesses of America have done really well. Now, granted, not every business in America has done very well. Here's the Russell 2000 index, and I find this to be, honestly, a more accurate indicator of how businesses in America are actually doing. The S&P 500 is a bit misleading because you're talking about the winner's circle when you talk about the S&P 500, the NASDAQ, the Dow Jones. Talking about the winner's circle. They've done really, really well recently, despite inflation being higher. But then there's companies like the Russell, which the Russell is a conglomerate. It's an index full of smaller companies in the United States. And what you can see here is that, yes, we've rebounded for these companies, but we're still very well off. We're still off the highs from, we haven't, from 2021's peak, we're still down 7.5% on the Russell index. Meanwhile, the S&P 500 during that same time has dramatically increased, 22% above those all-time 2021 highs. So the reason I bring that up is that, people out there, the average, consumer going to the store is not feeling incredible despite the stock market being up. But again, I think that that's a little bit misleading compared to the average business in America. I think this is a much more good example of how the average business, small business America is looking, right? Stock market is overpriced. Well, here's the difficulty. These companies sort of deserve to trade at a premium. Microsoft, Apple, Amazon, Google, these companies are like ATM machines. They just generate massive amounts of money. So when you're talking about those ginormous conglomerate, mega tech companies, they do deserve to, they've grown a lot more and a faster rate in recent years. than even small companies have, which have been really crushed by the high inflation and higher interest rates. Anyways, we're talking a lot of theory here today, but it's because, again, the UK saw inflation come down. If you're just joining the show, inflation in the UK is down to 1.7% on a year-over-year basis. That is quite an improvement. And what does that tell you about the UK? Well, it tells you the UK's economy is either really struggling, which is causing lowering of, or not lowering, but slowing in the rise of prices, or, I mean, that's probably a contributing factor, to be completely honest. The UK's economy has been a rough place in the last decade or two. But, what that also tells you is that likely, the central bank in the UK, or the Bank of England, is likely to look to cut rates. And if they cut rates, what does that do to the pound? Well, it usually will entail a weakening currency. So the pound has been sort of dropping off here recently, and you can actually see when this on the 5-minute chart, there's the CPI report. You can see why that impacted the chart so heavily. It's because, that CPI report really matters to the market. They say, oh my gosh, inflation cooling in the UK, that means rate cuts, sell the pound. So the pound got sold pretty hard overnight. And, that actually helps the story for gold, by the way. So when we go back to gold, when we discuss what's happening here, remember that gold is not only focused on the US, it's also focused on other, what central banks are doing globally. And the Bank of England is a big bank. So the Bank of England looking to potentially cut rates, seeing, that possibility seems to have been also a positive catalyst for gold. In fact, I bet if we take it down to a 5-minute chart and go take a look at 2 a.m. Time, let's look at that. There it is. Here it is right there. So UK inflation comes out, gold pops because UK inflation was down, signaling that the Bank of England is likely to cut rates further. Would UK inflation data strengthen the dollar? Lee, that's a great question. And the answer is probably yes. Let's take a look at 2 a.m. Yes, there it is. 2 a.m. UK inflation comes out, weak for the pound. Relatively speaking, the US dollar saw some strength. And the pound is looking a little troublesome right now, especially compared to that US dollar, which has been real strong here recently. We just had the US stock market open up, by the way. Here is your 15-minute candle. Yesterday, we saw a big slide in US stocks, and then we've kind of gone sideways. We'll see where they end up today. Stocks are just modestly lower here as the session gets started.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
If everybody thinks that inflation is going to go crazy, what happens to treasury yields? They go up. In 2022 and 2023, when inflation scares were everywhere, the bond market said, we are not accepting low interest rate coupons on our bonds. We want higher payments. We have to get higher payments to account for the possible inflation that's going to inflate our value of currency away. So people, the bond market basically says, give us better pricing on bonds. Give us more, basically. So this is very important to where the dollar index is each day. Because if the dollar index is, look at how closely the dollar index moves to the 10-year treasury. It's pretty close because it's tracking the Fed, seeing what the Fed's going to do, what the Fed's saying, so on and so forth. So that's really, really important that we're on the same page with that, because that is incredibly important. And all of the values, that are important to it, you can find right here. The economic data. The bond market is looking at things like GDP projections, PMI numbers, which are purchasing managers who are indicating whether they see the economy be strong or weak going forward. retail sales numbers, inflation projections, as well as what's been going on. Labor data is incredibly important. And of course, interest rates themselves. That's what the bond market looks at. And that's what the currency market looks at in regards to it. NASDAQ is a bullish reading. You got Dow, you got Bitcoin, some of the top setups here. Let's go ahead and take out neutral readings as well as minor currency pairs. Sorry, we want to leave majors, remove minors. This is my current watch list. I'm looking for Euro USD possible sell setups or short setups. S&P bullish setups, Nikkei, dollar CAD, the FTSE, NASDAQ, DAX, Bitcoin, Dow Jones. These are all possible setups from a lot of indices for the long side and Euro USD on the bearish side. Let's look at Euro dollar real quick because I'm afraid that this one just is not going to give me a setup here, which is fine. You know, I've been waiting on this one for a little bit. The Edge Finder's been really bearish on the Euro, which has been a great call, but I have not been able to find a technical pullback in my own strategy to take advantage of it. I'm glad some of you guys, you know, the treasury market, the bond market is actually a pretty requested topic on my channel, which I'm always happy to talk bonds. It's you know, I think it's a boring topic to most. I don't know. Can you guys weigh in on this for me? Maybe I'm just wrong. Maybe you guys actually find that stuff interesting. Do you want me to talk more about bonds or less? Type more or less. I don't know. I'm just curious what you guys think. Like in my head, I'm like, this is high level, boring, like finance bro nerd stuff to talk about interest rates. I'm currently in the process of potentially buying a house, actually, guys. I haven't talked about that on the channel, but it's especially interesting to me because, of course, we're looking into like mortgage rates, and that's, of course, impacted by the interest rate world. So it is especially fascinating to me right now. My wife and I are looking at a house, which may or may not happen, which is, you know, exciting. Okay, cool. I'm glad you guys want more of it. I mean, the bond market is so important. Like there's no overstating. I don't, you know, this is crazy to me that people don't pay more attention to the bond market. Like in retail trading land, I never see people talking about treasury yields, even though it's like the number one impact thing to the dollar index, and the stock market is really impacted by it too. And you know who's massively impacted by it is gold. So today you see yields falling, right? That's good for gold. When yields are falling, it usually indicates that people think, the bond market thinks the Fed's going to cut rates more. And when bond yields are rising, it indicates people think the Fed is going to hike rates or keep them higher, or not move them as low, right? So we've recently seen with the good labor data that came out, when you start piecing this stuff together, again, we had good labor data that came out. We could pull that up. Jobs data came in stronger than expected, right? 254,000 jobs were created compared to 147,000 jobs that were expected. That's for the month of September. So when we look at that, we say, okay, look, you got some hot jobs data prints. You've got inflation, which is coming down, but it came down less than what was expected. So let's flip over to US inflation on the Edge Finder here. So if we look at this and we say, okay, it was actually expected, by the way, to come down to 2.3. We're sitting at 2.4% inflation. So, you know, you got other central banks who are looking like they're going to cut rates sooner. I mean, look at the Bank of England today, 1.7% inflation year over year. Inflation is falling apart for them, or not falling apart. It's actually a good thing, but inflation is really falling over there. And so you've got that, and you say, okay, so the US dollar is probably going to cut rates, but maybe cut rates at a slower pace than them. That's a positive thing. So, you know, I think you take a full view of this and you say, well, dollar index looks strong because other central banks are cutting rates potentially faster. So the dollar index may continue to rise, in my opinion. But that's where we're getting, for currency traders, why, you know, economic data is so important and why yields are so important. And gold is reacting to this as well. When you get interest rates coming down heavy, right? That is very bullish for gold because it means a weaker US dollar. It means a weaker currency for, the buying power of currency goes down, which is really what you want to pay attention to. Sometimes people get confused. When I say a weaker dollar, I don't necessarily mean the dollar is going down. It could mean that the dollar's purchasing power is going down. Here's you guys ready for some complex stuff? The dollar index can go up and still be losing purchasing power. Okay? Think about this for a second with me. How can the dollar index go up and yet it's still losing purchasing power? Well, it's because if other currencies are losing purchasing power faster, if the euro's plummeting faster in value, if the pound is plummeting faster than the dollar is in value, then the dollar looks relatively stronger, even if it's also losing value, albeit at a slower pace. Kind of confusing at first. I know it can be a little daunting. Fundamentals are scary for people at first, but once you start getting it, it's like, oh, this makes a lot of sense. So when we compare, let's look at this, guys. Here's a great example. Why is the pound dollar weak recently? Because this is the UK inflation. This is the US inflation. We've mapped this out in the inflation tab. If you have the Edge Finder, go to inflation data, click on inflation CPI year over year, and you can map this out for yourself. Just select which currencies you'd like to. If you're a currency trader, this is probably one of the most important, studies you can do. So, the UK's inflation is coming down faster than the US's. Look at where these are on a relative basis. So which currency is likely to lose value faster? Right now, the pound. So if we go take a look at the price action of the pound, and by the way, that's being factored in. Let's go take a look. I don't know if the UK, let's see, where's pound dollar? Pound dollar is getting a neutral reading, perhaps for other reasons, right? COT data showed institutional money maybe buying the pound. Seasonally, it's not the greatest time for, it is a bearish time, and some mixed data on other fronts. But when we take a look at, again, the overall trend here of inflation, we go look at the pound, you can see why it recently has at least corrected a bit to the downside. You've seen this move from the top to the bottom. That's 400 pips down, which is a pretty sizable move. Bitcoin, by the way, guys, is looking really strong. I like Bitcoin quite a bit. It's a top setup on the Edge Finder right now. It's actually very close to, it's +9. It's the highest score. It's tied with the Dow Jones as the possible most bullish setup on the Edge Finder at this time. With Bitcoin getting a very bullish reading, I'm very interested.
I'm just doing the mechanics, like the numbers for you. If you had 8 winners, 2 losers, if you're collecting at least $1.50, it's not that bad, dude. I mean, if you had 8 winners out of 10, so you have 8 winners at $150, it makes you $1,200. You have 2 losers at $350, which would be that risk if you're 5 wide. You're losing $700 there, so you're still making, over the course of 10 trades, you're still netting $500. So that's with an 80% win rate. If you all of a sudden bump that up to, I'm not saying the win rate necessarily. I think it's going to be harder if you're getting, 7 winners. I think you can still make some money here. It's going to be close. 7 winners might be the spot you don't want to be at. So if we had 7 winners at 150, let's do the math there. So 7 times 150, that's going to be break even, right? That's going to be break even. Yeah. So if you have 7 out of 10, you're a break even trader if you're collecting 150. So if you switch that, like you said, to go, let's go 7 winners at 200 and 3 losers at 300. Now we have $1,400 in profit right there, and then we have $900 in losses. You're still making money, Frank.
So the strategy isn't different.
No, I know it's not, but I'm saying I lowered your win percentage, which is just helping you increase. I mean, I know you're watching price closely, and we're in an uptrend, and I mean, you're going to be crafty on how you position for them. But the nice thing is you could maintain a what's 4 and 6, so 4 and 6. So you if you're 60% collecting $200 a premium, you're going to be break even. If you win 7 out of 10, you're making some pretty good cash. You're netting $500. Like, that's really good, dude.
No, it is so good. Yeah. It's just that instead of taking the $1.70 credit and then seeing the price come down and then seeing higher premium. I'm just kind of getting the higher premium at the same spot, just kind of waiting for it to get there.
That's why I was asking if you just set a limit order. If you want the higher premium, set the strike you want and just set the credit that you want and consider taking that trade versus, I mean, if you're watching it, that's fine. But I guess, are you watching it because if you go like, 210, 215, that you want the higher fill?
At the start of the day, that's where I'm watching for the move. So I don't necessarily need a limit order.
Okay.
And actually, I mean, I do take a limit order every time. It's just at the price that it is at, so it usually fills immediately.
Gotcha.
So I'm watching really closely in the morning, waiting to get a price underneath the open, hopefully for close to $2, ideally more than $2, but if it's 170 and I'm right, it's fine.
Okay.
But the idea is to just get under the open. And if it takes a huge dip in the morning, as soon as we open up, I feel like that's a better opportunity as well. Because then price doesn't necessarily have to close green, just has to close above that. So even on red days, you can be profitable, which I like. It's just on the big days where it's like a 1% drop, just not a profitable day. But on days where it closes flat or slightly higher or whatever, you make money. So I like this.
Yeah, man, I like it. And I mean, if you're liking it, you're making some cash with it. That's great. I mean, you said 9 for 11 roughly. You've had 11 trades, 2 losses. That's got to be doing all right. Especially if now you're trying to pull in $2 of credit. That's obviously going to stack a little bit more of the odds in your favor, because you're batting, pretty high percentages, 80, 85, 90%. That's good. And I like it.
Yeah. I did a study on the weekly time frame as well. So we have a candlestick counter that we built. Just count green and red.
Yep.
And I took the last 100 weeks to the last 5,000 weeks on TradingView.
Okay.
64% of the time it's green, the last 100 weeks of trading. And then
so how many? So you're taking the last 2 years? 100 weeks of trading is 2 years, dude.
Yeah.
So what's the number? Like, give me what's relevant to that then. You went 5,000 candles back, but the last 100 candles were green?
No, I went 100 and then I went 500, then I went 5,000.
Okay.
And these are all weekly candles. So
yeah. So give me the most history. Like, what's the percentage of weekly green candles over like a 10, 20 year period?
I got 57%.
Okay.
The average of the time frames I took was 59% green.
Okay.
So if you
that's your built-in, that's your built-in edge, dude. I mean, the days, like every day in the market is about a 54% upside. Like 54% of the time we have green candles on the day, and I thought it was around 56% for weeklies, but you're saying 57% or so. The longer you go, it's like it probably gets closer, but I don't think traders appreciate how good that edge really is just to focus on being long-term bullish. Because if you went to a casino to play blackjack knowing that you have a 51% edge, if you're a professional player, you can make a fortune over a sample size of hundreds and hundreds of trades, thousands of trades, or bets for that matter, right? So that little edge is actually pretty nice. In a 54% daily or 56, 57% weekly, there's your edge. I don't know. It doesn't take much, but traders are like, instant gratification is what we want. We want to make a fortune. We want to YOLO and make $1 million overnight. It's like, I mean, look, if you just give yourself time to trade this stuff, you don't have to lose a bunch of money. Just stay the course and remember what this market's trying to do in the long run, which is trying to go higher. So, but in 2 years, it was 64% green. I know. Did you hear the numbers I rattled off yesterday? No. So I looked back at the last like 20 some years. Where is it at here? Yeah. So the SPX averages, right? We know the S&P averages about 8% a year, going back like, 80, 90 years. It averages about 8% a year. 2017, it pushed 20%. 2019 was up 29%. 2020 up 16% after a 30 to 40% pullback, by the way. So that's a huge rip in 2020. 2021 was up 27%. 2022 was a down year, about up minus 20. 2023 was plus 24%, and currently we're sitting up around 22 to 23%. So the point is, you just said the last, couple of years, high percentage of weekly candles have been bullish. Well, the last 8 years, right? The last 7 out of 8 years, we've seen 2 to 3 times the average performance to the upside. Like, this market is freaking juiced. Like, this is a bullish market on steroids.
What was 2022 again?
Minus 20%.
Yeah, okay.
The way it finished the year, minus 20%. Yep.
But 1 year's minus 22%. The rest are like 16 to 25%. 16
to 27% upside. Yeah. So it's the same thing as taking, that's 8. It'd be like taking 8 trades. So I have 8 trades. And I see some comments in here. I see the NAS and I see the pound. We can talk through those. Frank and I are just having a conversation. So if you have, let's say you go 8 trades.
I mean, we're kind of talking about the NAS right now. We're just talking about the market.
Yeah, I know. So we have winners. We have 7 with an average. We'll average those out. And then we have a loser at minus 20. Okay. But our winners, we have a 20, 29, 16, 27, 24, and 24. Okay. So if you just stack these up, it's like, if it just take this as like, I just took 8 trades and I have 1, 2, 3, 4, 5, 6 winners. Is that right? 1, 2, 3, 4, 5, 6. Oh, I forgot the 16 in there. 20, 29, 16, 27, 24, 24. Yeah, whatever. Good enough. 1, 2, 3, 4, 5, 6, 7
trades.
I guess it's 7 trades. Okay.
So 6 out of 7 are winners.
But if you stack these up, where it's like, what's 6 out of 7 win percentage? 85% of these trades, these years, 85% has been positive, and the net gain, I mean, just it's ridiculous. And what's funny is, like, anyone that got burned in 2022 is like, I don't know, I'm in cash. I had clients that wanted to just sit in cash and sit in money markets and sit in certificates of deposit for after, not during 2022, but after. And I'm like, look, man, I mean, I finished 2022 with like 19% gain in 2022 in a shitty year, and clients were still worried about everything, and they're just like, I just want to take my, I like my money market at 5%. I'm like, okay. And then I told them not to rub it in, but I'm like, you're probably going to see a good return in 2023. And what they do, they sat in cash, they sat with no risk, which is fine. I get it. But the market went up. What was 2023? 24%.
I mean, they're also not professional traders like you. So sitting on cash in 2022.
But I'm their trader. That's my point. I was trading for them, and they made 19% in a bear market, and it wasn't good enough. It's just like, it baffles me, dude. So that's my point. I'm just like, the loss aversion and how powerful this sentiment stuff can be. It's like, you're up 140% over a 6-year stretch, and you lose 20%, and you're like, I want to go to cash. You see my point? It's like, I'm just trying to show, like, loss aversion is so powerful that people see what's the saying where it's like, you can't see the forest through the trees, right? So like, right now, this little lens, you see the 20% loss, you hear about the 20% loss, even though clients made money. It's like, wasn't good enough. It's like, okay, whatever, dude. So yeah, I just think it's an interesting phenomenon that loss aversion is very real. It's very powerful, and
the fact
I see it every day.
19% in 2022 is really good.
Yeah, it's okay. I know it's okay. So, all right. Anyway, I see pound dollar. Let's go to that. Let's go pound dollar quickly. So the dollar index is still, not ripping. It's drifting higher, right? So you're seeing all your dollar crosses that are still dropping. I did analysis this week on the pound crosses, or the dollar pairs rather. To me, this dollar is still looking like, until it turns, this dollar looks like it's still able to go higher, right? I mean, this is such a perfect squeeze trade. I mean, this little bear trap down here and squeezing the way it's been squeezing, don't call the top on the dollar right now, which means don't call the bottom on the pound dollar. I like this area for resistance. You know, this to me is pulling back in this big inefficiency spot. So if we pull back into here, cool, right? If price proves that it's going to reject off that, then maybe we look for that to return back to the lows. But that's about the area that I look for dollar weakness if it confirms. If it doesn't, and it just gets up here and it stays here and it stays here, and it could be a bull flag or something, it might just melt up more. So don't call the top on the dollar. Don't call the bottom on the pound dollar. Look, the pound dollar to me is way more attractive. It's right here, Frank. You see this little inefficiency right there? I like that spot on the daily. I like this spot on the daily. I'd like to see this drift a little bit lower if possible. Try to come down here and you know, grab some support. Try to find some trend line support in this area, and then look for confirmation to then buy it, and buy it nice and low, and then trade it back up to these inefficiencies. So that to me is the trade I'd look for. I'd look for like a 129, 128, 127 area. And if I get it, those are great for spots to buy, and then see if they come back up and find those pockets that were created on this way down with the dollar strength. So I'd wait. I don't know. I'd wait.
I like it.
I think there's good opportunities on the dollar pairs after the dollar's done doing its thing. But I think that confirmation is not ready yet. Same thing here on the euro dollar. Actually, in the top strategy session that I did yesterday, Nick chimed in, but we talked about this one, just talking about Forex trading and talking about trading pockets and inefficiencies. You know, we're satisfying this inefficiency right here. This doesn't mean that I want to buy it right now. I'd rather see if the euro dollar can continue to come lower, right? Because if we start forming support or support or support, then this is the area I'd look for buys to then come back into the middle of this range, come back in. You know, there wasn't really a ton of inefficiencies here, but I would say on the smaller time frames, let's go down to a 1 hour chart. And this is actually perfect here, Frank. Check this out. So in a couple, I would say this candle right here looks pretty promising for some type of inefficiency. So, and look, take a screenshot of this and see if this ends up going back to that yellow box that I drew around 110. It wouldn't surprise me is if you just wait for a second and wait for this structure to trade or break. It's done with the bear side, and maybe it's done here and it starts to go back up, or maybe it's done lower, but it starts to go back up. I mean, you could set this thing up for a trade that, you know, if it's nowish and we go up to 110, there's 120 pips or so for that. If it comes down to, 108, there's 200 pips. We come down even lower towards the major support. We're talking about 350 pips of profit right there. Like, that's good potential on a little bit of confirmation. That's all. So yeah, I like that trade. If we break, I think that's a probable pocket to fill. If we fill this pocket entirely, you know, look for this to be some type of manipulation here and some fake outs, and we start to break structure, we go back up. I mean, just be patient on the stuff. Traders have to pick their trades, you know, wisely and carefully. And this is using a lot of price action and structure. Aussie dollar, see that request coming in too. This is spot on here, man. Look at this Aussie dollar. This, Frank, I couldn't ask for a better pocket right here. That trade right there on Aussie dollar. So what do I want to trade? Do I want to buy Aussie dollar right now? Absolutely not. You know why? Because if there's a chance this thing can come down to this low, okay, then maybe you look for a bounce in here. Otherwise, I wouldn't buy this thing until we come back down to like 165 or 164.50. And the nice thing is that's my pocket. That's my liquidity area. That's my efficiency area. And so it can come down here, you know, take out this low, pattern out here, and then work its way back up. Or it comes all the way down here, patterns out at the bottom, and then works its way back up. So patience. There's nothing to do. I mean, if you sold it, you saw resistance. You sell it high, it's going your way. But now that we created this, eventually price is going to come back to that level. You know, whether it's this level support or this level support, we're likely coming back to this 68 to 68.50 zone. But don't force these trades where, and this is what happens. Traders see this pocket and they get all excited. They start buying right away. You know, they start buying it here. It's like, why are you buying there? Look at this low, you know, and it's called sweeps and it's called block chains or order chains or whatever the hell people call it now. Look, to me, it's efficiency and inefficiency. It's structure. It's support resistance. You know, I'm old school, I guess. But it's the same thing. It's just price action. So if we come down here and we poke these lows and then we start to show some promise, then yeah, you can take a stab at that one and go back up and put your stop loss in, you know, when it's appropriate, when price is actually going higher. Otherwise, if I zoom out, I just like bigger picture, man. bigger picture, zoom out, this to me is a much easier trade. I don't even have to worry about the Aussie dollar until we're coming down to an attractive level, okay? But if it trades back into that yellow zone that I put on the 1 hour chart, okay, fine. It's just in the mess. It's in the mess of the middle. But if it comes down to this level, it's way more attractive here to buy that thing nice and low. And so to me, I hope we get it. I hope we go back to 64, 63, 62, because I'll buy it like crazy.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.